Bitcoin price behavior can be approached as an interaction between liquidity preference and collateral dynamics, rather than as a simple story about adoption. In many phases, participants treat Bitcoin as a balance sheet asset. They increase exposure when they feel funded and confident. They reduce exposure when funding becomes uncertain or when drawdowns threaten risk limits. This produces a repeating pattern of accumulation, acceleration, saturation, and reset, with each stage visible through how quickly the market accepts higher levels and how violently it rejects them. A distinct framework is to evaluate Bitcoin through three frictions: entry friction, holding friction, and exit friction. Entry friction includes access quality, settlement speed, and the ability of large players to acquire size without moving price too far. Holding friction includes custody readiness, regulatory comfort, and the psychological cost of volatility that tests conviction. Exit friction includes exchange reliability, liquidity depth during stress, and the cost of converting exposure back into cash or stable collateral. When frictions are low, trends can extend because capital can move efficiently. When frictions rise, trends can stall because the marginal buyer steps away and the marginal seller becomes more urgent. Another useful lens is to separate organic demand from synthetic demand. Organic demand is spot-driven accumulation that does not require leverage to remain profitable. It can tolerate drawdowns and still hold. Synthetic demand is exposure created through derivatives that depends on funding, margin, and continuous mark-to-market stability. A market dominated by organic demand tends to display slower, but sturdier advances. A market dominated by synthetic demand can display rapid upside but is prone to abrupt air pockets because a small drop can trigger forced-to-risk events that are unrelated to long-term beliefs. Bitcoin also exhibits inventory migration. During quiet periods, inventory often moves from active traders to patient holders because volatility compresses and short-horizon participants lose interest. When momentum returns, some of that inventory migrates back into circulation as holders monetize gains into strength. The transition points are often detected by changes in how rallies behave. A rally that continues with limited pullback suggests that circulating supply is scarce. A rally that repeatedly stalls at similar heights suggests that supply is being released into the bid. Correlations should be treated as conditional rather than fixed. At times, Bitcoin trades as a high-sensitivity risk instrument tied to broader markets. At other times, it decouples and trades on idiosyncratic crypto liquidity conditions. The condition that often matters is whether market participants are constrained by dollar funding. When dollar funding stress rises, correlations can tighten because many assets are sold to reduce leverage and rebuild cash buffers. When funding stress is low, Bitcoin can reflect internal flows and positioning more than macro movement. Price discovery is heavily influenced by how liquidity providers manage adverse selection. When order flow is calm and two-sided, liquidity providers can warehouse inventory with confidence and spreads remain contained. When order flow becomes one-sided, liquidity providers reach size, spreads widen, and market orders move price farther. This transition can make a move appear sudden, even if the underlying catalyst is modest. After such a move, the key question becomes whether new limit bids appear to create stability, or whether the market remains thin and vulnerable to continuation in the same direction. From a strategic standpoint, Bitcoin exposure benefits from governance rules. A robust approach begins with defining loss capacity in portfolio terms, then selecting position size that remains survivable under unfavorable swings. If volatility expands, Risk rises even if the coin count stays unchanged, so risk control must respond to volatility regime shifts rather than to emotions. For participants with multiple objectives, separating a long-duration allocation from a short-duration allocation reduces decision conflict, because the long-duration allocation can be managed by periodic review, while the short-duration allocation can be managed by pre-planned risk limits. Operational resilience is part of the return profile. A good plan includes custody procedures, device security, redundancy for access, and a tested pathway for converting exposure during stress periods. Many failures in this market are not about being wrong one direction. They are about being unable to act when the market moves quickly. USDT assessment. USDT functions as a transactional unit that enables pricing, settlement, and collateral operations across crypto venues. Its central value is speed and reach. It compresses the distance between markets by providing a common unit for exchange. The stability of USDT in practice depends on confidence in convertibility and the ability of market participants to perform arbitrage at scale. A distinct way to analyze USDT is through a triangle of parity, mobility, and acceptance. Parity is the tendency to trade near $1. Mobility is the ability to move the token across venues and networks quickly and at predictable cost. Acceptance is the breadth of platforms and counterparties willing to treat USDT as high-grade collateral. Stress can appear in any corner of the triangle. Parity can wobble if confidence falls. Mobility can degrade if networks congest or withdrawals slow. Acceptance can shift if large venues adjust collateral terms or if counterparties reduce exposure due to policy or risk management changes. USDT pricing deviations are often better understood as a fee for immediacy. In calm markets, arbitrage compresses deviations quickly because traders can move tokens and dollars with low friction. In stressed markets, frictions rise, transfer times lengthen, and balance sheet becomes scarce. When that happens, a discount can reflect the market paying a cost to exit quickly, and a premium can reflect the market paying a cost to obtain collateral immediately on a specific venue. Reserve and redemption considerations matter, but the decisive practical point is throughput under pressure. Even if backing is adequate in principle, the market cares about whether conversions can occur smoothly when many holders act at the same time. If conversions are perceived as slow, the secondary market